Hi guys, it's me again, mangomonkey from mangomonkey Lends Money. Well, today I will briefly talk about passive ETF and active ETF. For you who do not know, ETF stands for Exchange Traded Fund. So it is a type of managed fund investment that you can buy on the stock exchange without talking to anyone. You buy an ETF just like you buy ordinary shares, ordinary stocks. A lot of ETFs are passive ETFs, but some of them are active ETFs. What's the difference? So in an active ETF, you have a fund manager or a few fund managers who actively make subjective investment decisions whether to buy or sell particular stocks or bonds. In other words, the fund managers will choose what they want with the hope of selecting investments that will give the fund the best return on investment. For this service, the fund managers will charge you management fees that are significantly higher compared to passive fund managers, because nobody in Australia works for free.
And we do not have universal basic income yet.
Whereas with a passive ETF, a lot of the investment decisions are done by a computer. So for example, if the fund tracks the ASX 300 index, then the computer looks at what companies are in that index and the weighting of those companies, and the ETF will aim to have similar weighting in their fund as well. What are the benefits of passive ETF? Well, the first benefit is the cost. So with a passive ETF, the cost is normally extremely small. The fee is something like 0.1% per year of your investment balance. If you look at an active ETF, you will probably pay more than 1%. The other benefit is the potential tax efficiency, because with a passive ETF, they do not sell your shares very often. So that means your capital gains tax do not get charged as frequently, because capital gains tax is only charged when your investments are sold by the fund manager. The third benefit is a lot of the times a passive ETF will have a bigger number of companies because the computer makes the decisions and the computer is very smart at keeping track of things. So it's very easy for a passive ETF to have hundreds or even thousands of companies. With an active ETF, usually the number of companies will be less than 100. So how do you tell whether an ETF is passive or active? One way is to look at the fee. If the fee is something like 0.1% or 0.2%, it is probably passive because it's not enough to pay the salary of a human fund manager. If the brochure says something about being an index fund, it's probably passively managed as well. If the description says that the objective of the fund is to track a particular index, for example the S&P 500 index in America or the ASX 300 index in Australia, then it's probably passive. If it doesn't have any of these keywords, it's probably actively managed. Which one do I believe is the better investment? Warren Buffett seems to like passive ETF because the fee is lower, and over time the compounding effect of the fees is actually quite significant. So even though the fee is only less than maybe 1% per annum today, if you multiply this by 10 years, it's already 10%, and this is before taking into account the effect of compound interest. It's probably going to be around maybe 15% better off in 10 years. And the thing with fee is that it is guaranteed, so the fee will always happen. Whereas if you hope for better investment performance by investing into actively managed ETF, the performance is not guaranteed, so you don't know whether the fund will actually perform better compared to the passive ETF. I personally like to invest in actively managed ETF or actively managed fund because I have someone who actually spends their full-time working hours to monitor my investments and choose the best companies that they believe are the best. Of course, Those companies may not turn out to be the best, but at least I know that somebody smart is spending all of their working hours to try to help me maximize my investment return. This is not investment at first, and I am probably wrong, but I think when we are in a bubble market like now, it's even more important to invest in actively managed fund. Because how good is a computer compared to a human being? A computer may not know that there will be another market crash coming. But if it is a human, the chance of that human knowing that there will be a market crash and the chance of him selling our investments are higher compared to the chance of a computer being able to predict and sell our investments ahead of the crash. With an actively managed fund, the fund manager does not need to follow the index to the letter, so if they think a particular company within the index is risky, they don't have to invest in that company. Whereas if you go with a passively managed ETF, a lot of the times the computer will buy the company anyway, and it may even be a requirement of that fund to hold whatever companies are within the index. That will do me for today, guys. Thank you again for listening in. I hope you've seen my video with this $100 trillion that I recently obtained, and it's making me feel very rich right now. This is $100 trillion from Zimbabwe. I would love to go there one day. Thank you again. Happy holidays. Have a lovely day. Hope you're doing well, and I will see you in another video.